All right, let's talk about an investing strategy that sounds, well, kind of wrong, but is actually incredibly smart. We're going to dive into why sometimes the absolute best thing you can do with your portfolio is to be, lazy.
I love this quote from the Nobel Prize winner Paul Samuelson. What he's really getting at is that good investing shouldn't feel like a trip to the casino. It should be boring. And that one simple, counterintuitive idea, it's the key to everything we're about to talk about.
But that brings up a really good question, right? If boring is so good, why are we always trying to make it exciting? We're constantly bombarded with this idea that we need to be active, find the hot new stock, and outsmart everybody else. But does chasing that thrill actually pay off?
So here's what we're going to cover. First, we'll look at the big problem most investors are up against. Then we'll introduce the lazy fix, we'll show you why it works with a pretty surprising story, give you some actual examples, and wrap up with a little pro tip to make it all even better.
Okay, first things first, the investor's dilemma. This is that constant pressure, that uphill battle of trying to be smarter than the average, to pick the winners and avoid the losers.
So to figure out if that's even possible, we've got to look at the data. And the absolute gold standard here is something called the SPIVA scorecard. Think of them as the official referee in the big match between active investors and, well, lazy investors. Take a good look at this number, 65%. Just let that hang there for a second, because what this number means is pretty staggering. This is the percentage of professional, highly paid fund managers who failed to do their one job in 2024, beat the market average.
And look, this wasn't just some one-off bad year. In 2024, 65% of these pro-match funds couldn't keep up with the simple S&P 500. The year before, it was 60%. And if you zoom out over almost a quarter century, the average is 64%. The people with all the fancy degrees and research teams consistently fail. That's the dilemma. So, if trying to outsmart the market is a losing game for most people, even the pros, what's the alternative? Well, that brings us right to the lazy solution. And yeah, we're going to completely reframe what lazy means, from a bad habit to your most powerful strategy.
So what is a lazy portfolio? It's really, really simple. It's just a handful of cheap, broad market index funds, which are basically just baskets that hold a little bit of everything that you buy and then you just leave them alone. No daily check-ins, no frantic trading.
I love this way of looking at it. You're not trying to swing for the fences and hit a home run. You're just trying to get on base, consistently, every single time. By buying the whole market, you're not betting on one company. You're betting on the entire economy. And then you just let compound returns, your money making money, do all the heavy lifting for you.
Okay, but how? How can doing less actually lead to more money? Well, let me tell you this fantastic little story that shows this perfectly. It's the case of the second grader's portfolio.
Check this out. It's a total showdown. On one side, you have this super complicated ultimate portfolio with 11 different funds. Looks impressive, right? On the other side, a simple little starter portfolio with just 3 funds. You'd think the complicated one would crush it, right? But nope, the simple portfolio actually made more money. So what in the world is going on here? How is that even possible? Well, the secret, the real game changer, isn't about how many different funds you own. It's all about one single concept, your asset allocation. In other words, how you split your money between stocks and bonds.
And hey, this isn't just a fun little story. This idea is backed by one of the most famous studies in the history of finance. This research found that about 90% of your investment results have nothing to do with which specific stocks you pick. It all comes down to that big picture decision of how much you put in stocks versus bonds. All right, so the why is clear. Now let's get into the how. What does this actually look like in real life? Here are a few well-known lazy portfolios that show just how easy this can be. I mean, just look how simple these are. The couch potato portfolio is a dead simple 50-50 split. Rick Ferries just uses 2 funds to own the entire world's worth of stocks and bonds. And the no-brainer from William Bernstein, great name by the way, splits it 4 ways to get a little more variety. See the pattern here? Simple, low cost, and spread out. Okay, now for anyone who wants to level up just a little bit, there's a simple but really powerful trick you can use. It's all about putting the right investments in the right accounts to keep more of your money away from the taxman. Here's the deal. Think about your accounts like 2 different buckets, a taxable one and a tax-sheltered one, like your IRA or 401k. The smart move is to put your stock funds in the taxable bucket. Why? Because you mostly only pay tax when you sell, so the money can grow undisturbed for years. Bonds, on the other hand, often kick off interest payments that get taxed every single year, which is a drag.
So you want to shelter them in your IRA or 401k to avoid that annual tax hit. It's a small change that can make a big difference over time. So let's just boil this all down. The lazy investing mindset is really just 4 simple steps. 1. Pick a simple plan and a mix of stocks and bonds. 2. Invest on a schedule, like clockwork. 3. Check in maybe once a year just to make sure things haven't gotten way out of whack. And 4. This is the hardest part. Do nothing. Just let it grow. And that really leaves us with this final thought. We live in a world that is screaming at you to do more, trade more, optimize everything. But what if, when it comes to your money, your greatest advantage, your real secret weapon, is just having the discipline to sit back and do nothing at all? It's a pretty powerful idea. Thanks for tuning in.